Managing trades. Let's say that hypothetically you have this chart in front of you and you were looking to make a trade, and we're going to accelerate time here as we usually do. We see that price has gone into this consolidation of about 80 pip consolidation. Then it's narrowed down to a 40 pip consolidation. Then it's narrowed down even further to about a 20 pip consolidation here. And the longer this consolidation goes, the bigger the breakout, potential breakout, or the more volatility that could erupt from this scenario. And we start to see a breakout from this small consolidation, and it rallies 60 pips and 80 pips, and you see this breakout happening. And because you're a good trader now, and you've studied these CDs over and over again, as much as your eyes are starting to burn a little bit, but you've studied all of the little idiosyncratic details of trading, and you've become very astute. And we see as a result of this breakout that we're not going to trade this high right here. We're not going to trade because we see it rallying. We're not going to trade 12200 with the anticipation that it's going to go straight up another 100 pips without even looking back. We're going to wait, and we're going to wait a little longer, and we might even wait a little bit longer. So now we see that price is bouncing down here, and we can continue to wait. Now right around here would be a good entry as price tests this previous high. So you enter at 161.70 is your entry. Let's say 75. So you enter at 21.75, anticipating the next leg up. And lo and behold, we get a nice rally, which is quite a shock that this would happen in one of these simulated scenarios. We're also, this high is also converging with the 10-day moving average here. And so we rally, and we're on a by the way, we're looking at a 120-minute chart, so it's a 2-hour chart. And say that we're in this long-term position, and we see that price has now made a high. Then what we would do is this. We're going to be following price with our Fibonacci's. In fact, I would probably take it from this last point where price took off out of this consolidation. Now we need to manage our stop accordingly. So we entered here about 75, and we have a high here of resistance at about 2200 is where price bounced at the figure. It retraced down here to 65. The 79% retracement is at 90. What would be a wise thing to do at this juncture is to move your stop from down here where the entry would have been. You probably would have had your stop around 50 or so with a 75 entry. Now you'll take your protective stop and you'll move it up below the 79% retracement and below this last level of resistance. Now should price continue to move up to the 162% extension, then what we would do is we would take our Fibonacci and we'd pull it up to the new swing. And there's two things we can do. Number one, we can leave it here at this high. The Fibonacci on the larger swing here is more profound. It's a stronger level of support. I think it's wise to leave the Fibonacci on this swing where we have the 38% retracement converging with this high here. And what I would do is I'd take my stop and move it up below the 62% extension, which is still pretty safe. at this stage, just as we watch to see what price will do. And we're actually 120 pips away, so it would even take a full day of trading. We probably would not even get stopped out if we had a full day of trading down in this direction. Now this is assuming, of course, we've taken reasonable profit along the way here before 2200 and beyond, and we have maybe 10 or 20% of our position left. So we'll leave our stop down here below the 62% retracement. Price comes down to the last level of resistance and tests the 38% retracement. Continues to move up. But meanwhile, you're getting up and you're going to work every day and you're hanging out with your family and you're going to play golf and you just have a position trade sitting in there until on the larger time frames price looks like it may come in and form a reversal pattern against your position. And we just continue to watch price as it moves up. Maybe once a day we open our computer, or once every couple of days we open our computer as we continue to see price moving up. And while all this price action is moving up and down, we can just simply be at peace because we've taken some profit. We've got a nice accumulation now, and we can now simply move our Fibonacci's up even further, and we'll take them on the last swing here from this low. And you can actually move your stop below this low, or you can move it behind one of these Fibonacci levels. But the higher you move it up, of course, the more at risk you are. So I like to keep my stop below the average true range if possible. So Euro is unlikely to move 150 pips down or 200 pips down and stop me out all in one day. I can also leave it behind the 10-day moving average. Right here is another place I can leave my stop. Or I can move it up here behind the 10-day moving average and the 79% retracement. And we continue to watch price. Now it moves up to the 127% extension. And it settles down a little bit, and as the market makes new highs, we can continue to move our Fibonacci levels up on the last reasonable swing. Clearly identifying our levels of support and resistance. As we watch price continue, we're at 2600 now, and it's we had a nice retest of this level right here, and we move higher, and we had a nice retest of this level here, right here, and right here at the moment, and we continue to move higher. So then of course we can move our Fibonacci, continue to move it up. We can move it maybe up to these lows now and look for protection, but try to keep it 100 pips or so away as we get into these big trends. Then if you just feel that price has run into a significant key level on the larger time frames, then you can simply get out of your trade. Like, you can get out of it now if you like at 2700 is fine. But that just gives you an idea as to how you can trail your stop behind the market.